I see that Jamey Kohake, our next speaker, is actually online right now. So we'll actually just move right into Jamey's presentation here in just a minute. Um, First, I'd like to do a little bit of an introduction of Jamey. He's spoke with Montana Farmers Union at a couple of our conferences in the past. He works for a company out of Topeka, Kansas called Paragon Investments that specializes in trading large and small. So he works for both small livestock and commodity producers as well as commercial, and works on ag risk and also hedging markets. Jamey has been advised on has worked with producers on price trends, cash grain analysis, and marketing strategies. He's been both heard on ag radio, multiple TV programs, and we're just lucky to have Jamey with us. And we look forward to hearing today on what the markets are doing and planning for the future. So I'll turn it over to Jamey.
Thank you, Justin. Hoping the technology works. Can you guys see my screen?
Yep, you're good.
Okay, perfect. Yeah. Thanks for having me again. Like you're saying, we are a ag consulting company, do a lot of hedging, a lot of grain price marketing in the cash markets for customers pretty much all across the Midwest. We run all of our trades through ADM in Chicago, and that's our clearinghouse with that. We've been in business since 1998. We started the consulting firm in 2006, and have been pretty much the same book of business, not a high turnover rate at all, just a very, very conservative kind of a hedge type niche commodity office. All of our customers receive daily comments via voice and written comments as well. And then customers do receive comments midday if there is extreme market volatility, and phone calls as well. Then USDA reports, we send phone calls out, and then all of ADM's research, all of our customers get for free, Hightower and ADM's personal stuff. But we're kind of in some wild times right now. We had a big sell-off late last week in the ag sector. We saw a lot of fund liquidation, over 40,000 corn and 40,000 beans on Friday. Most of it was all technical. Nothing really changed at all with the weather situation down in South America, and also too with the tight supplies and the soybeans. But we kind of erased all that here this week, and had a really kind of a wild trade here this morning as well. Corn down 0.5 cent now. Beans are still up 2 to 4, but we are sharply higher overnight. Open up a little bit better, went actually lower, then back higher already. Now we're heading back down again right now. Today would be 3 days up. Lots of funds trade in 3-day increments, and we're looking for the market to maybe put a little short-term high in here by the end of the week as we head into February with the crop insurance month. So pretty much what we do all day long is sit here, look at spreadsheets on the phone, talking to customers. We develop, customized plans for each customer, just not a blanket one for everybody, no matter what state or area you may be in. And we do puts, calls, futures, strategies, all depending on the customer's risk tolerance and their break evens. But we just pretty much sit on the phone, work with customers all day long, and try to control their risk. It's obviously row croppers, cattlemen as well. I mean, you're spending millions and millions of dollars just to make 2, 3, 4% some years, and just so risky, especially with the heavy volatility right now, all the global stuff going on, new administration in DC, and how all that plays out longer term. So pretty much what we tell customers is the market is always right. It doesn't care what your backyard looks like, if you got the best crop or the worst crop ever. And obviously too, the USDA reports, no matter how bad or good they may be, the market doesn't care. It's always right. And so we tell customers, let us pretty much handle all the outside noise like that, and let us know your break evens, and let us kind of sit here and pull our hair out and talk trash on the USDA if we need to, or whatever. But we try to keep all the emotions out of everything, and don't like to play the news headlines. It's going to rain in tonight, or it's not going to rain for 5 days. We're not a herky-jerky, knee-jerk reaction type trade firm. We just pretty much follow our break evens and our hedge strategies as well, per tolerance per customer. Most people don't actually do a true hedge. Most guys will say, "Well, I'll put a hedge on." They make a little bit of money. They may not, and it turns into into a spec trade. But most guys don't understand the risk involved. They don't understand, offsetting it in the cash markets. They get busy. They think the market will come back if they don't hedge. Like right now, guys have gotten lucky. You go back to June, and pretty much the market was expecting a major bloodbath, and we could be at LDP levels, and thankfully we have not. And we've been laying grain off pretty much the whole way on this rally, and even started into the new crop sales for next year. But we're really big on locking in break evens, and guys, like I said, they may miss big moves in the past and they got burnt or lost a ton of money, then didn't sell the cash on the opposite side. So you really got to have a really customized plan of when you put a hedge on, if you sell futures, buy puts, sell calls, whatever, of when you lift a hedge, offset it with cash sales, and most guys turn that into a speculative trade and say, oh, it'll go on higher, or lower, we'll keep the hedge on or blow the hedge, and the basis will get better. And I've seen it happen so many times, and lots of times both sides turn into a loss. The basis widens out and the futures may go higher. You kept your hedge on too long and never took advantage of either one. So we're just really detailed office, and strict guidelines of, here's both sides of the market. One happens, the other one does as well. Traditional hedging really just involves, selling futures. Your break even, say corn is 350, futures are at $4, so we just maybe would sell futures. And lots of guys will say, I don't want to. My grandpa lost a farm back in the 50s doing this, and I'm just gonna hope for a weather rally this summer. And weather rally doesn't come, and you see, they puked out of the low, they got scared, the crop is here, and never really took advantage of the market at all. So we tell guys, you put a hedge on, say you sell the board, you keep that hedge on no matter how bad or how good it is until you actually sell your grain. And don't trade them in and out and get caught up, like I said earlier, with good news or bad news and hoping it comes back, or turning, both sides into a speculative trade. But if your break evens are right, your strategy, you let us, handle it. It's less stress. You don't have to worry about USDA reports or packing plants getting caught on fire. I mean, just crazy nonsense like that, or what happened late last week. If you're hedged up, you have the grain. It's just so much less stressful for producers, and let them do what they're good at, and let us sit here, and stare at these screens all day long. Farmers of the future really are I think, going to be kind of the really good ones are going to have a few really important things about them. They're going to be great marketers. They're going to know how to hedge cash markets, and on the CME group, they do take risk, not crazy risk, but like I said, they know their break evens. They know how to handle risk. They know how to lock profits in. They can cut costs without losing yield. They time management very good. They're not laying in bed till noon every day, then heading out to the farm and back home at 5 o'clock. They keep their numbers updated, their homework updated, their numbers, accountants, everything. They always know where they're at. They take care of the land on top of technology. Very active in trade groups. That's always tell guys is, be involved in trade groups like you guys and have your voice heard, and make sure, the leaders know the good and the bad of the ag sector, what's going on right now. But time management is very key. Marketing is, I think, the next one, and you have to take a little bit of risk if you're going to continue to grow or not. Here's what we think will happen in the next 5 years. Economy in and out of recession. I think we're going to have, obviously, a lot more regulations coming on the market and the economy here with the new administration. Tax code could change as well, very drastically. So could be in and out, back and forth, depending on how globally the market rebounds with COVID. I think labor pressure increases, skill gap labor increases, where it's going to be very hard to find maybe a guy that can do 2 or 3 different jobs. You're going to find somebody that's really good, or you're going to have to train him, to get up to where you need to be at. Supply chains will tighten up. And then obviously the big one, I think you're going to see more and more corporations buying out farms, buying out inputs, and it turns into a bigger and bigger monopoly longer term. Here's kind of an interesting fact that we researched. Going back to like the 1920s, we only had 6 million farmers, and they fed 121 million Americans. 2017, we only had 2 million farmers, and we fed 330 million Americans. So you can see the technology and how it has to continue to increase. The population around the world is going to continue to increase, and we look at the exports right now. We are selling a lot of grain overseas. This morning we had 3 fresh sales, one in corn to China, 680 million metric tons, which is huge, and one in beans to China, and one to an unknown destination in beans as well. But we need to keep the production numbers going and look for the demand to keep getting better and better. Over the next 10 years, USDA expects an additional 90 million tons of production, and we're just going to continue, like I said, to see the population grow worldwide, continue to need protein, and we're going to continue to need, to get more and more acres somewhere, and if not, increase yields to really keep the supply going worldwide. What I'll cover next is the USDA report that we saw on January 12th. And everybody was kind of lined up on the bullish side coming into that report, assuming the carryout was going to drop drastically in beans, and we could be limit up off that. And we saw a big rally coming into it. And we're still kind of pushing off of that number as well. But here is a price summary sheet that came out that day. If you go on to the far right over here, you kind of look at change from December 10 over here. Wheat prices, they're expecting to be 15 cents better than December 10th, up to 485, 27 cents better than last year. Corn, 20 cents better in roughly 1 month, 64 cents better than last year. And you go on down to beans as well, 60 cents better and over $2 better than last year. And you continue to go on down, look at, steers and hogs, and the numbers all look extremely good as the futures market has rebounded to support those numbers. We think the numbers could be a little bit low on the corn and also the soybeans. We are still longer term bulls here, thinking we could still put another 50 cents on corn and maybe put another $1.50 to $2 on beans, depending on what the weather ends up like during planting season here. We will see the South American harvest start really heavy in about 2.5 weeks. We'll see how those yields come in early on, but we still continue to really need more and more supply as the carryout continues to tighten. Here is some more updates from the January WASDE report. The market was trading bullishness in the beans, especially off dry Argentina weather. Southern Brazil was very dry as well, and everybody was expecting lower corn and soybean production numbers. The areas in Argentina have softened a little bit. They have been getting moisture, and also lots of areas in Brazil besides the Mato Grosso area have rebounded to with some decent moisture. But market is not thinking they're going to have a bumper crop yet based off of that, and we're still pricing more into the upside. If you're going down here to the bottom, the big surprises for the report that we saw was lower corn stocks and also lower corn production numbers. And we'll get into that here in a few more slides. Here are the rolled numbers for corn. And if you continue over here in this column right here where the blue is, you can see the rolled production numbers just continue to shrink. And you look at Argentina, Brazil, European Union, and those numbers have really showing up, obviously carrying over into our numbers with lower production as well. And we continue to see the carryout drop. And we're down to roughly about 1.5 right now. We think we're probably end up closer to about 1.2 longer term. But the exports have really helped the market out. We've had weather issues in China. We had weather issues obviously in South America, Baltic Sea area over in Europe, very dry as well. Over to the supply and usage numbers. We saw the stocks, a little bit lower. This is corn worldwide. We saw the production number. The crop came in just roughly 10%, lower than what the market had expected, and the production number is roughly 10% as well. But you can see down here, the big number I think is this 5.1% lower than ending stocks number 283. We were versus 303, and that's where you get a lot of bullishness longer term, as the demand has really shifted to us, as we've seen huge exports, and I think we continue to be the leader here until obviously probably April, May time period, when South America gets done with the majority of their harvest, and see their prices. China prices right now with corn at $11. For Chinese corn. That's what their price is right now in China. So you can see why they're buying from us, very aggressively, when it's it's cheaper, just about half as cheap to come over here and buy it from us. Here's a supply and demand sheet. This is for domestic corn, U.S. corn, and this column over here in the blue as well, where we came in 0.2% lower here on the planted acreage number than what we had thought, harvested acres as well. And the big number that I think really shook the market up was 172 on the yield. There were some estimates expecting 175 coming into this report, and this is what really I think supported the market more than even the carryout number in the beans, was this yield number in corn. And we saw a huge kind of windstorm move through Iowa late in the growing season, wiped out a ton of acres, took off the top end yields there as well. You scroll on down in here, they got us forecasted at a 14.1 crop size, and you going down to 16 on the total supply numbers. But like I said before, you get down here at the bottom, that's the key number. I think the 1.552 ending stocks number, 150 lower, from where we were a year ago, and 10.6 on the stocks to usage number. We think those numbers continue to drop. One number that we continue to question is ethanol. How that plays out longer term. With the domestic usage here numbers dropping off, we see crude continuing to move on higher and higher. Here today we're at 53 and change, up 57 cents. But we think with the new administration policies already, with with the pipelines and other stuff as well, that the energy markets, crude oil, will push back towards $80 a barrel, and that'll help the ethanol market out big time. We do think the administration is pro biodiesel, ethanol, and that'll help out as well with policies. But we think the big driver will be gas prices going higher, and that'll switch over to some better ethanol demand. But 420 here is the average price the USDA is saying. We think if we could be closer to $5 on that ourselves. Here is world soybean production. And the big numbers you want to look at here: Argentina a little bit lower, Brazil a little bit better. Those numbers have dropped off here in the last couple of weeks on some private estimates, but not a really big play here with the world soybean numbers on the USDA report that we saw, and the bigger play was on the domestic side. Here is usage numbers and supply for worldwide, and the number I like here continuing is the stocks number. You see how much sharply lower we were from year to year, roughly 11, and we look for that number to continue to shrink lower and lower. We don't think that the USDA numbers are still maybe a tad bit too high yet with the Brazil production numbers, and they'll be lowered eventually and continue to support the tightening on the ending stocks number. Here is a supply and demand sheet, just like the one we saw in corn for the U.S. numbers, and you can see year on year where we were in acres, harvested acres, and then on the yields where we ended up at. But the big player here on the report was 140 down here on the carryout ending stocks. We think we're probably closer to about a 110 is what we think, and continue to shrink lower and lower. Consequently, we've seen kind of a rationing rally, here roughly since Halloween, especially though really since Christmas. And I think, we could still see, $15 beans yet longer term. That we pretty much have the only beans on the market now worldwide. And until the South American harvest gets rolling hard, we just see the number continue to shrink lower and lower, and think that average market price is way too low right now at 11.15. But funds are still long, even though what they did on Friday with corn and beans, and we think they'll continue to defend their positions. Over to the wheat numbers, the report on wheat that we saw was pretty much neutral, not any big changes at all. And the wheat market pretty much just got tangled up with corn and beans and had that spillover effect and went on higher with it. But not a whole lot of big changes that we're seeing here at these big numbers. We are seeing some dryness, over in Europe with the Baltic Sea area. Also, too, with the exports with Russia, them shutting them down as they have a very short crop, similar to what Argentina did, shutting down their corn exports as they need it for domestic usage. But other than that, the wheat numbers really didn't have an effect on the market at all. Here's the supply worldwide and usage, and you see the numbers, not a really huge game changer, from a year ago, a little bit better, but not a whole lot. The supply with wheat the last really 5 to 10 years has been pretty comfortable worldwide, and we're finally maybe getting into a little bit better markets now as we've had the weather issues around the world, and we had a decent crop here, and hopefully hopefully we'll shift over into those. Sorry, phone was ringing. That demand will shift over to us from the weather issues worldwide. Here is a wheat supply and demand sheet, and not a whole lot of changes at all. You can see here in the blue column, nothing major. Yields, 50 versus 51 and change. And the carry out down here at 836. But wheat, we look for it to stay supportive as exports stay decent. We think that 485 is probably about $1 too low, and look closer to $6 prices. But the wheat is going to be a follower longer term, depending on what corn and soybeans do. If they can hang on, the wheat will go higher with it as well. Here are some numbers on acreage, and you can see going back, roughly 10 years ago, we harvested just about 300 million acres, and that's pretty much where we are still, roughly this year. And you see, the planted acreage numbers 310. You go back 2011, 314, not a massive number change at all there, but based on supply numbers right now, based on worldwide demand numbers right now, factor in increased population numbers worldwide, we're going to have to see this trend continue back up higher. We just don't have this, the longer term supply right now based on technology and acres to continue to supply the world. Here is where the principal acres, pretty much were planted at, what increased and what decreased. And you can see up in your area, we lost a couple million acres, picked them up back though in the Midwest, and the Dakotas took the biggest hit with weather still from roughly 2 years ago, just still continue to pile on the market. Here's where we ended up in corn for last year. We planted 90 million and change acres. That was about tiny number lower from the previous estimate, but a little bit better from the previous year. Then you go over here to harvested acres and the yield. The yield number, like I said, was the big factor on the report and this rally that we're seeing, where we were down 2.2 from what we expected, even though we were better from last year. But that really shook the market up there and still continues to be supportive yet right now. If you go over to the big states where they're expecting 220, 250 yield every year in Iowa, Illinois, Nebraska, Indiana, parts of Minnesota, they all planted more acres. The only state that got beat up on yields over here was pretty much Iowa, and that was with the summer windstorm. They had a big I-80 wipeout pretty much with the wind, and also too the areas that didn't get blown down pretty much lost the top end of their yields. And you can see it too, how it affected their production numbers. But everybody else had a decent crop and didn't have any really major weather issues this summer at all. Here's a sheet of corn yields, and you can see where we are, at 172. trend line is this diagonal one kind of in the gray going higher and higher of where we need to really be at. And I think with technology and also too, getting more and more acres, I think, pulled out of CRP longer term, we can continue to see that trend shoot higher and higher to the upside. Here are the yield numbers that we saw nationwide from last year. And so you saw Iowa take a beating. Here's Montana, a little bit better than we were last year. And really the only major growing state was Iowa that took a beating. Nebraska, tiny one, but nothing major. Here are the production numbers that seen going back roughly 10 years, and we're kind of stuck in a sideways channel, producing from a 13 to 15 billion bushel crop pretty much every single year, and don't really look for that to change a whole lot, with 15 kind of being the cap right now based on current acres, and not really going to see, I think, a big game changer with weather to the bearish side yet, as La Nina continues to be a big factor worldwide. Here are our soybean numbers. Here we planted, 83 and change, a little bit lower from where we were last year, from the estimates, but bigger from where we were a year ago. Yield number 50, really big number there. Production big as well. And then you go over here to the yields on the major growing areas. Iowa took a beatings, kind of similar with corn, and Nebraska a little bit as well. But soybean production came in better pretty much across the whole entire Midwest than what anybody had thought. And here are the yield numbers. Ended up at 50.2, above trend line, and really big time number for soybeans. When you go back and looking in the 90s, we're 30 bushel beans and getting roughly 20 bushels better, within 30 years. And here's just a chart of the states that had lower yields: Nebraska, Kansas, and Iowa. Everybody else had better yields. And then the production numbers, similar as corn, really stuck between a 3 billion and a 4 billion bushel production number right now. And then also to continue to throw on South America, increasing their acres, and weather issues, and the market could flip over within a year or two if we have better growing seasons down in South America. But right now, what we're being told from ADM and their research department is this market longer term, roughly about a year and a half, should remain supportive, continue to trade on higher, as it's probably going to take about 2 growing seasons to really recap and resupply the carryout numbers, especially in the soybeans. Here are the wheat numbers that we saw. We saw, the acreage number, planted acres, not really be a game changer at all, pretty much unchanged. And these are the planted acreage numbers. Texas lost a little bit, so did Washington. But really the big wheat areas are us, talking being Kansas, 23%, and then everybody else, roughly that's the rest of the market. Here are the acreage numbers for wheat. The yellow number is what we harvested, and the orange number here is what we planted. And we really ran into a dry summer down here in our area with the winter wheat, and a lot of guys ended up burning it off or tilling it up and going back to beans with it. And I just really saw those acres get hit hard. Here are the planted acreage numbers for winter wheat. And from the previous year, we still had better acres, but lost a lot of those when it came harvest time, as there was nothing there. Then our wheat stocks numbers here, as we continue to really be just like corn and beans, really just stuck in a channel of similar stocks pretty much year on year. And our supply numbers that are blue stayed the same year on year. And you go back and look at the other 3 lines down here from summer till fall, and everybody's seeing that kind of number drop off little by little. Back to the corn stocks number, and you can see where we were in 2021, 16.1. Then you go back to the December crop report, and we're at 11.3. And I look for that number to kind of continue to shave on lower and lower down to the bottom right side of the page and continue to support the market. All that based off of pretty much what I said earlier, with the exports being very, very solid, Chinese corn roughly twice the price of ours, and still very much uncertainty yet down in South America. Here's a similar sheet for soybeans as well. I look for this number to continue to drop off. 4.6 is where we expect it to be or estimate it to be at, and then here in D1. And like I said earlier, that number should continue to drop as well, as we are pretty much the only supply of soybeans on the world market, and continue to look for those numbers to export numbers continue to get better and better for us. Switching over to another market, livestock update. We think with COVID vaccines being pushed pretty aggressively around the country, that should be bullish for meats, as restaurants should be opening back up, cities continue to open up, and hopefully increase the demand there. We saw another record year of profits by packers. They took major advantage of the producer again. Estimates of up around $700 per head is what they were estimated at times last year. You go back and look at the packing plant out in Western Kansas that got caught on fire. One room, box beef shot through the roof, cash prices dropped, and just packers just made a killing. Grocery sales up higher, obviously off COVID and the lockdowns. Consumption of beef increased by half a pound, pork lower by half a pound, and chicken up by about half a pound. But as a whole, we like the cattle market here longer term to remain bullish. The only market that really got hit hard this summer past year was hogs, and it was the spring summer contracts that really just took a bloodbath. Some of them, losing close to 50% of their value. And we're starting to rebound a little bit right now. We have the swine flu going on in China. Hopefully that will increase demand over there with pork, but we think we really got the worst factored in right now with the hog market, and look for them to put at least another $2 to $4 onto the upside. Here's where we're looking in the forward outlook with cattle. Supplies continue to tighten. We're looking at high cost of gains, with corn up in the 5s. Some of the cost of gains down here are over $1. And we look for the placement number to continue to shrink, as guys do not want to pay that high cost of gain. We look for the exports to continue to be very, very strong, and we look for the consumer sentiment to actually increase as well to the bullish side as the country gets more and more vaccinated and big cities get opened back up, Chicago, New York, LA. But we expect the stock market to remain strong. Another big stimulus bill probably coming this spring. And look for really the worst, I think, in the meat market here should be factored in. Hog outlook, like I said, we're bullish per production on increasing. Guys lost a ton of equity, this past year. We got a ton of barns here in the Midwest that are just completely empty. And then with the swine flu in China, we look for the market to remain very, very bullish. And be glad to answer any questions if you have them.
Does anybody have any questions for Jamey? Jamey, what do you see do you see more trade opening up with the new administration?
Yes, I think we will be going back into the old trade agreements that the ones, especially one in Asia. I think we'll be back in probably that within 6 to 9 months. And I don't think we're going to be, fighting NATO, even though that wasn't a big ag play. But I think we are back to where we were with Asia, and with the supply situation, worldwide, that should benefit us more and more with exports and keep the market supportive.
Good. Is there any other questions out there? Jamey, online, or can people, do you do a daily market reports like on
Yeah, we do. Just feel free to give me a call. My direct number is 785-338-4111, and we can set you up with free trials of everything that we have, and go from there with it, and see how the market kind of reacts here as we get into crop insurance month in February, then our planting season with weather, and see if we can keep this market supportive. But like I said earlier, we're still bullish longer term, the row crops, and all based off supply and demand, and look for, maybe $15 beans and $5 new crop corn yet. And I think that would probably be enough here short term, unless we have a major wipeout with our planting season.
Sure. And for those that are interested, the Paragon website, the address is what, Jamey?
Yeah, P as in Paul, iitrader.com.
PIItrader.com.
Yes. Mm-hmm.
All right. If there's no further questions, we'll take about a 10-minute break, and then we'll get moving on with the rest of our morning with Andy Junkin coming up.
Thanks, Justin.
Appreciate all your help, Jamey. And
Thank you.
we'll be in
Good
touch.
to see you.
Yep. Thank you. Have a good one.
Bye.